So when it comes to startups, you remember we discussed about one of my investments where I said I took a projected profit margin based on uh, this current sale number. Okay. With startups, you will need to project, not just project the profit margin by understanding the industry, but by understanding the growth trajectory, you will also have to project uh, the sales number. Or if it already has sales and you think that sales, you want to value it based on that sale only, then you apply the profit margin to that number and then look at things. Uh, I'll tell you an example. Startups tend to be a very uh, so with startups, there are methods that can be used like price to sales, like your price to earning as a ratio, uh, especially in acquisition of either startup stake or acquisition of a small established brand. Uh, People look at price to sales as a benchmark. Okay, now price to sales simply tells you how many times are you willing to pay of the current sale of a company. See, that's uh, for comparison, apple to apple comparison. You can do all that. You can create any ratio and you can do that. But price to sales or sales to price, the percentage does not tell me anything. It doesn't have a meaning. Okay, it only tells me if the company is generating 10 crores of sales, uh, how many times of that sales am I willing to pay? You don't have a benchmark, you don't have a logic in your head to compare. Like when you say price to earning, you say a company is earning 10 crores and I'm willing to pay 100 crores for it. You are effectively paying a price to earning of 10. Okay, but when you invert it, you get earning by price into 100. You do it as a percentage, you will get 10%. Now,
Right.
10% is the return that you are generating, okay, on an investment of 100 crores. Okay, so that is sort of logically clear in your head. With price to sales, you can't invert sales by price and say, if it is 10, I'm getting 10%. No, that doesn't produce anything because sales as a number is not the final number. It's a top line from which you have to reduce a lot of expenses and come to the bottom line, which is the profit. So
Right.
startup valuation tends to be very tricky. Startup valuation is more on uh, projected sales, projected profit margin, and more importantly on how capable the person driving the ship or steering the ship is at it. Okay. Startup valuation is a very different subject in itself. It is, it's, and I don't claim to be a master of it. And honestly, if you ask me, I will not go and invest in startups. I mean, when startups come to me and they ask me for capital, whatever the capital is. Okay. I tell them I am not willing to give my capital to you. I'm willing to give my time capital to you. I'll work with you for an hour a week and you give me an advisory stake. It could be 0.05%. I'm okay with that. But I'll not put my hard-earned money. I can wager with my time, but not with my capital. So that's my method of dealing with startups. And I don't put a lot of time into them. Usually they require a lot of time as well in terms of advisory mode. So startups are better off, you're better off avoiding startups when you actually want to do hardcore investing. Venture capital is not investing. Venture capital is sort of trying to, uh, you don't know how many birds are in the bush. You are just gambling that there are some birds in the bush. Or you are banking on your experience and you are sort of speculating. It's not a form of, I wouldn't, it is questionable form of investing, I would say. uh, you should always ask how much profit does this how much profit in return I'm getting for an investment that I'm making. Okay. So till you're getting that, you should not go ahead and invest in such things. That's my personal opinion.
Right, right. Yeah, I think yeah, that's definitely right. More unless we have really large fund and we are putting like a VC thinking. As a normal investor, it doesn't. I mean, it's not advisable to get into startups. Or
Exactly. You don't have that corpus.
right, right,
If you have the corpus to invest in 100 companies at a time, startup investing makes a lot of sense. But if you don't have it, then it's a tricky business. You should always be wary of investing in startups.
right, right.
Okay, fair enough. Hiral, would you like to share anything? I know you can't speak much, but if you want to give your inputs, feel free to just type in. Okay. Okay, let's get started with portfolio management. This is going to be a fairly short session, but it is going to give you an insight into how you should go about investing uh, the total sum of money that you have. So, portfolio management effectively means whatever money that you have for investing. Okay. Now, first of all, please do not invest any money that you need within 3 to 5 years horizon. Don't invest your short-term funds. Don't invest anything, your emergency funds into the market. Those are things that are better off staying in liquid places, even if they do not generate returns. You should invest only something that you're willing to forget for good 7, 10 years. Okay, not even 5, 7, 10 years is what I say. A lot of people will say you should go ahead and invest something that you are willing to forget for even 5 years. I would say be only invest something that you are willing to forget for really long time, because that will give you really good return. Within 5 years, the probability of you generating good returns is high, but not it's not near certain. For a 7, 10 years horizon, if you do your research right, uh, yes, practically it's never certain. Investing is not a certain field, but with all the risk management, which means analysis, with thorough analysis and proper valuation, you can always come up with opportunities that are near certain opportunities. Okay. So the probabilities will always be in your favor. So always only invest something, or your corpus or your total fund should be something that you're willing to forget for at least 7 to 10 years or more. Okay. You remember this equation? Investment management is investment analysis 49%. Uh, in total of investment management, 49% is investment analysis. Just 2% is investment valuation, because it's just a method, garbage in, garbage out, good in, good out. Portfolio management is the another other 49%, and we have only one session dedicated to it. There are books and there are research papers that are written on portfolio management, and there is Harry Markowitz and modern finance and whatnot that have who have I mean people have gone ahead and done PhDs in portfolio management and have written models, created models based on which the advisory and the fund management industry tends to create jargon and talk to potential investors, and people who do not understand too much or who graduate out of these schools tend to talk too much about those jargons. Uh, Practically speaking, any good portfolio manager or any good fund manager rarely uses any text that is taught in any B school. Okay, because all those texts that are written are based on a few assumptions, or modern finance as a subject is based on a few set of assumptions. The first assumption is people are always rational. From your experience, you can figure out whether that is true or not. Uh, and it assumes that people always look for high return, low risk opportunities. Now, if that was the case, you would not be talking about VC investing. People are rarely rational. Okay. It also assumes that there are no fictional costs. Okay. It assumes that risk and return are directly proportional. If you remember, in the initial sessions, we had discussed about an example of uh, uh, a quote by Buffett where he said, if I take a gun, put 6 bullets, roll the magazine, and put the gun to your head and tell you that if I shoot, uh, I mean, not 6 bullets because a revolver has 6 holes. Say, for example, if I put 3 bullets in a revolver which has 6 slots and I roll the magazine and I say, uh, if I shoot and you live, you get 1 million. Okay. And in the next instance, I add another bullet and say, uh, if I shoot and you live, you get 2 million. That is risk and return being directly proportional. Okay. But in markets, when you're buying something at 100 rupees, you have the risk or layman risk that you can lose is 100 rupees. Okay. But if the same asset is available for 50 rupees and you buy it at 50 rupees, the maximum you will lose is 50 rupees. Okay. Now, coming to the return side, if the potential return in the first case was 50% or the thing was worth 200 rupees, was 100% in the first case. In the second case, the return would be 400%. Okay. Some or 300%. You can calculate for yourself. What I'm trying to tell you is there are places where risk and return are not directly proportional. You can always get higher return for lower risk, which I just showed you. So if something is actually worth 200 rupees and you're getting for 100 rupees, the return potential is less compared to when you're getting the same thing for 50 rupees, right? So if you are if you have good eyes, you will pick such opportunities. Okay. And hence risk and return are not directly proportional. Okay. So there are a lot of things that make s- I mean makes a strong case that all the text written on portfolio management is nice for theory and nice to get PhD, but never is really applicable in the market by practitioners, by serious practitioners. So we'll see. I'll give you an introduction of what is applied in the markets. First, uh, the step after business valuation, once you have calculated the value of a company, you need to compare the value or the intrinsic value that you have calculated with the price. Okay. Or you have to compare it with the current valuation. Okay. The current market capitalization at which the company is being valued by the market. And if and check whether the company's share is underpriced or overpriced. When value is greater than price, it is underpriced. And when value is lower than price, it is overpriced. So you got to understand. I've knowingly written overpriced on the right side and underpriced on the overpriced on the left side and underpriced on the right side. Which of the two is underpriced? Uh, the one which has the balance in black or one which has the balance in blue? In which of the two cases the business or the stock is underpriced?
The right side is underpriced.
The right side is underpriced.
Left side is
Is that
under.
the case?
Left side
Left
is
side
under.
is underpriced, right?
But
So
it is
see,
heavy means it is price is more, right? If it is actually going down means it's I mean, in a weighing machine.
that's an interesting perspective. So
What I was
uh,
thinking.
I think Himadri is right. Value, wherever you have heavier value, that's underpriced, right? Srikant?
Yeah, the left side, which is the one heavier value, and
Right
okay,
side, right side is the heavier value in terms of value, right?
okay. You're right. Correct.
So I kind of tricked you into believing that the left one is actually underpriced. No, it is actually the right one which is underpriced. Very good, Himadri. So always remember the distinction between price and value. Okay. Uh, these two terms are very similar to if you are to relate uh, in a colloquial way, understand that one of them is akin to reputation, the other is akin to uh, your character. Which one is similar to character? Which one is similar to reputation? Who can tell me? Is value similar to character or reputation?
Value is character.
Shrikant, what do you think?
Yeah, same.
Pranay, what do you think?
The same, I think.
Right. Hiral, I hope you agree. So value is your real worth. Okay. And what others think about you is price. Okay. We are in the business of calculating value and comparing it to price. Never confuse the two. Okay. Fair enough. Moving on. Now that I've decided which stock to buy, how do I choose how much of my total available funds should I invest in this one stock? How do you choose how much you should invest in one stock? Any thoughts, anything that you would like to share? How do you decide that? Pranay, Srikant, you have been practicing, so we'll hear from you. How do you decide how much you'll put on one opportunity? Forget stock. Out of the total funds, how much will you put in one opportunity? How do you decide that?
So, firstly, based on the probability of your chance of winning, and
Mhm.
number two is I never followed, but I want to follow the 5% rule,
Okay.
wherein out of 100 rupees, I first put five rupees on one
Mhm.
particular thing. Uh,
And
yeah,
100 rupees is your total funds?
yeah. If it is 100 rupees, example, five I will put in one thing, and if my conviction is good over a period of time, then I put more money on the same thing.
Fair enough. Thank you. Thank you, Shrikant, for answering. Yes, Pranay.
So my the practice I am following is basically, mm, if I don't, I will only invest that money, just like you said that it's for long term. So basically, uh, for anything I need to put for more than 7 years,
Mhm.
that's one thing. So basically, I will be putting from my total 100%. Basically, my 50% is into mutual funds first of all,
Mhm.
where I think there is less risk,
Okay. So
and
are they equity mutual funds or are they liquid funds?
some equity mutual funds,
Okay.
and also some liquid funds which I require for my short term. So if my idle money is getting into bank, so I put into liquid funds,
Okay.
and out of 50% I put into equities,
Okay.
direct equities.
Okay.
So of that 50, so I just, my practice is I just put, I have only 5 stocks in my portfolio. I try to keep 5 stocks, not more than 5 stocks.
Mhm.
So basically I try to put some 10 10 10 10 10 10 rupees of 5 stocks in that portfolio for equity. That's the practice I'm following.
Fair. Okay. Thank you, Pram. And what is it based on? How did you come to the number 10% in each stock of the total? Or you just decided it's going to be only 10%?
Mm, Basically, after doing some uh, that just normal, I think.
Okay. Fair. Thank you. Himadri, would you like to add from your practice? How do you do it?
Yeah, I mean, I haven't invested in Indian stock market as such, but I mean, in general, what I think is definitely one principle. What we discussed was not to diversify. It should be minimal in terms of number of stocks that you pick up. So obviously, after doing all the analysis and all the things, if you have a good conviction, I mean, obviously, out of the total investment, the stock or equity portfolio should be some percentage. So maybe around, for me, I think 25 to 30% of my total fund can be put on equity, and within those 25 to 30%, obviously based on the top 5 companies that are evaluated and which are qualified to be investable, and then I think the percentage of whether it is 5 or 10 can be uh, can be decided based on at what time we are entering into the market for those companies. Maybe we can change, like if it is early stage companies, I mean, where it has a huge growth, maybe you can allocate little more higher fund, if not equal distribution. But within that 25%, let's say, instead of distributing maybe 5 and 5, maybe you can pick up uh, 2 3 companies a little higher, and 2 3 companies which, because all 5 will not give you exact ranking, right? So I would prefer to make it ranking, even though you selected 5. Maybe put up a ranking and then try to divide the fund into based on the ranking.
Well, thank you. Thank you. Okay, now that we have heard all of you, I'll just share what I do. Uh, Hiral, can you talk? Hiral, by any chance, can you speak? Oh, I saw your message now. I'm good, Hiral. Okay. Uh, let's. Okay. So my approach is a little different from what you people said. So my approach is like, if I have, say, a total fund base of 100 rupees, I would invest all of it in equities because that is what I have decided for long-term investment. I I go ahead and invest in mutual funds only when there is an ATC requirement. My whole logic of doing that is simple. That, you know, if I have, my profession is fund management, why should I pay someone else to manage my money? Okay. So that's the very reason I don't invest in mutual funds at all, other than ATC. If I could manage ATC myself, I would do that as well. But that's how the world works, so I don't do it. But apart from that, of the total, how do I go about it? I go based on the conviction that I get from an investment, and my conviction is completely dependent on the probability of success of an investment. Now I broadly divide my investment into 2 categories. One is cyclical, the other is secular. I do cyclical investing not because I am a specialist in it. Cyclical opportunities present more often than secular opportunities. So, uh, if I had it my way, I would like to invest 100% in secular, and I will reach there someday. I'm yet to reach there, but till then, I try to allocate 25% or less than that, depending on how much room I have in the portfolio, towards cyclical companies, because they are more frequently available opportunities. Truly secular good bets, you tend to get far, and uh, you get them rarely and very far. Sort of, if I could, in my historical experience, I have been able to get um, real secular long-term bets probably once in 3 or 5 years, not earlier than that. Um, One good real secular bet, which I'm talking about, I would get it probably, if I can get 2 in 5 years, I would consider myself lucky, um, of secular investments. And on the secular side, I tend to really concentrate heavily. So on the secular side, I go by the probability of success, the probability of success, the potential return that it can give. At the same time, the uh, probability of success takes care of the probability of failure. So yeah, uh, that's what I base my conviction on. My conviction is based on potential return by potential risk, and uh, based on that, I go ahead and invest in it. And in secular, I have a rule that I'm not going to put less than 10% of my total portfolio in it. I'll put more than 10%, 10 or more. Okay. Uh, and with cyclicals, I tend to have a rule where I will not put more than 10%, probably more than 7.5% of my total portfolio in them. Sometimes five is the minimum, 7.5 is the maximum to which I'll go. Maybe till 10 also I would go, but not beyond 10 in cyclicals. So cyclicals, the average weightage tends to be 5%. I average or minimum tends to be 5%, and uh, that's on the cyclical side. On the secular side, the minimum tends to be 10%. I only go higher than that, and till I get something which is really good, I will not consider that as a secular investment. And that's how I have practiced fund management, or my style has evolved. And given my way, I would prefer my cyclical part to vanish and secular part to be 100%. And over time, my number of companies in my portfolio have reduced from 12 to 10 to 8 to presently 6. And of them, three are uh, secular, which contribute close to 85-90% of the value, because they have grown, or probably 95% of the value. And uh, the rest of the three are cyclical companies, which contribute very less. Not because I allocated less, but over time they have not grown, or they have not grown as much as the secular ones. That's about how I go about things. But let's see what I have for you. Okay, here is a scenario for you. Let's say you've got 100 rupees to bet with minimum bet size of 20 rupees. You've got five guys proposing one girl. You know all of them have some positive chance. How will you decide how much you will bet on each? You've given me your portfolio management styles, but let's do it just for an example. How much, what percentage of 100 rupees will you bet on each guy? Will you bet equally? Will you bet more? What would you, how would, on what basis you would decide it? I'm not trying to understand the number, but I'm trying to understand on what basis you will decide whether you will bet higher on a guy or not. I understand the simplest way is to just bet 20 rupees each on each guy. But would you, first of all, bet higher on any guy? Is the first question. Would you bet more than 20 rupees on any guy? Yes or no? Let's start with the answers. Kiral, you can type in your answer. Pranay, Himadri, Shrikant, feel free to answer.
Uh, we need to bet on the guys who's proposing
Yeah,
to the girl, right? So, I mean, obviously,
positive outcome is the girl saying yes.
yeah. So, obviously, if you're taking the equation of one guy is only going to get the girl, so there's no point of investing on other people. So they will just be a hard luck. So our chance is to actually find that guy who can actually really get there, right? I mean, you should be able to bet, even if it is 100, to the guy who is going to have more probable chance of win. If the or the other way is, because it does not clearly present the moat or something, ideally we should not be in betting at all to any of these guys, because you don't have a clear, if you don't have a clear moat within these five guys, so what's the point of going? Because you
That's
cannot
good.
go and evaluate anyone, because if all of them have same equal chance, there's no point of betting on any of them.
Well, great. That's a good answer. Thank you. Srikant, what do you think?
I think I am also aligned with Hemadri. Either I put 20 or none. 20 each or none.
You'll put
Because as per the
either
current
20 in each.
information, as per the whatever the information I have
Right.
in the screen, right? So we really don't know out of five who's the guy, right? So we
Correct.
don't have the information. I would prefer not to invest.
Great. That's one of the best things that you can do in portfolio management, is well left, as Sunil Gavaskar has wisely said for years till IPL came into being. Okay. Pranay, what do you think?
Rightly said by Srikant also. Unless and until I don't have any information about the boy, the five boys, so it's not worth uh, putting in to them.
Okay. Cool. Thank you for your answers. Okay. So your bet size, if at all you were to bet, would depend on, like Madri said, it would depend on your, if you don't have any information, no, you're not going to bet on anyone. But if you have information, it would depend on what?
Probability of winning.
Or your conviction?
Yeah. Conviction.
Exactly. So bet size depends on your conviction, is the relationship I was trying to form. How do you decide uh, put- how much portfolio allocation you want to make for a particular stock? So, sorry. Sorry. So your portfolio allocation would depend on your conviction, is what has come into. Okay. Okay. Now that we have established this logical relationship, I will take you to another world or another uh, stream where we'll talk about sending and receiving of signals. Okay. So this idea has an analogical backing from signal transmission. Okay. So how much, what intensity or how much of a signal should a sender send? Uh, I mean, back in the copper wire days, this was a question. How do you make the transmission of signal more efficient? Okay. So it it basically answered whatever we are going to discuss, basically answered how much of a signal you need to send from the sender's end, the intensity and the quantum of the signal that was to be sent from the sender's end to have a proper reception at the receiver's end. Okay. And this feat was attained by John Larry Kelly, who came up with this criteria called Kelly criteria. Okay. So Kelly criteria is nothing but the quantum of signal that you should be sending to receive a proper message on the receiving end. Okay. So you can read the text on the screen. I'll give you a moment. This very criteria was can be used to estimate what proportion of your wealth should you risk in a sequence of positive expected value bets to maximize the return rate of return. Okay. Now, we'll not get into the details of this, but we'll come to the formula. The Kelly criterion formula is bet size depends on bet size is equal to 2p minus 1, where p is the probability of favorable outcome. Bet size is the percentage of total funds to put in one stock. Okay. So this aligns with the conviction logic that we just formed based on our logical thinking. Does it or not? What do you think, guys? Yes, no, maybe? Hiral thinks yes. What about you? It depends on the probability, right? Conviction depends on probability, and
Yeah.
the bet size is being decided based on probability. Yes, Rika.
Yes. Yes.
It does, right? Hemadri, Pranay?
Yes, yes.
Fair enough. Hemadri, I hope you can listen to us. Fair enough. So it's a fairly straightforward formula. I'm not going into the details of the derivation of the formula, or else uh, you will have a head like me. We, we don't. I don't want you all to have a head like me. All clean. So we'll talk about just the formula 2p minus 1. Now, suppose does it mean that if the probability of something happening is less than 50%, should you bet on an event? P is the probability in decimal terms, okay? Not in percentage. Should you bet on, or even if you do in percentage, 1 is an absolute number. If the probability of success is less than 50%, does how much weightage does the bet have?
0.
It's actually negative. It is 0. Here, with 50, it is 0. You're right, Shikha. If it is less than 50, it will be in negative, right?
Yes.
Can you have a negative bet?
No.
Okay. What do we call a coin toss? When we toss a coin, what is the probability of heads and tails coming? 50-50, right? So we say a coin is left to chance. So 50% is chance. Is if you have 51% probability, how much should you bet on it? If there is 51% probability, what should be your bet size? Or should you bet or not? Two into 51 is how much? Guys, 2 into 51 is how much? 102, right? 102 minus 1 minus 100, because we are talking about absolute number. So it is actually 1.02, not 102. If we are taking 102, then 1 becomes 100. 102 minus 100 is how much? 0.02. 0.02 percentage is what you should bet on one particular bet, or 2%. Sorry, 0.02. Hang on. 1.02 minus 1.02 minus 1 will be 0.02. 102 minus 100 is, so you will be betting 0.02%, right?
Yeah, around that much only. Correct.
Right. So that's an insignificant number to bet, right? So you would say no. Now, the obvious question you're going to ask me is, how is it that I am going to come up with the probability number? Now, please understand this clearly in your head, that the probability number is a subjective probability that you will come to based on your analysis. It's not an objective number. You're getting it? Yes, no, maybe.
Yes.
It's a subjective
Yes,
number. You can make it objective with a model, blah, blah, blah. Good for you. But effectively, it's converting subjective into objective. Okay. So it's your ability to convert quality into quantity that will play here. If you have a 55% chance, what percentage of your total funds will you bet? Quick. Quick, guys.
10%.
Exactly. When you have 60% chance,
20.
exactly. When you have 75% chance,
40.
sorry,
40. 70%. 40.
75.
75. Okay. 50%.
Exactly. So that, and okay, so should you be betting on anything that is less than 50%?
No.
50% chance? No, right? You should also not be betting something which is 51, 52% chance. You're not trying border risk. Okay. Don't do all that. Okay. And never try to allocate 1%, 2% of your portfolio into things. Have a minimum bet size. 1-2% investing is good when you have hugely humongous portfolio and you are into uh, venture investing or private equity sort of investing, where you are investing in very large number of companies and they've got very good payoffs. Okay. Here we are into equity investing. You've got, with your capital, you can invest in limited number of companies and their potential is not like venture investing, nor is there risk like that. So have a minimum bet size. Whatever, how much you should have is not for me to tell you. It's for you to decide. We heard portfolio management style from 4 people. All of them have a different style. Some commonalities are there. Portfolio management is very similar to something that we'll discuss in the forthcoming slides. Okay. But you understood this formula, right? Any questions about it? It's very difficult to have very high probability events. Okay. So whenever you're saying that, this has a chance, 75% chance of having, just ask yourself, that means I'm willing to bet 50% of my net worth on it. Is it actually having 75% chance? Okay. So ask yourself whenever you get confidence. Like I said, portfolio management is akin to one thing, and that is fingerprint. It's going to be different for different people. Some people will have 100 stock portfolio, some people will have a 3 stock portfolio. Okay, you got to decide where, and this is a spectrum, 3 200 or 1 200. All the people who have got extremely rich have been people who own just one company. Now, you're not a founder who knows a company, and you're not someone who has just found a company like a Microsoft which is growing, or a Facebook which becomes Meta later and whatnot. So unless you are that kind of a person, one company is not your thing. If you are not that kind of person, 2 or 3 companies is at least what you will bet on. And then there are extremely risk averse people who will say, I'll bet on 100, 150 companies. When people buy 10 mutual funds, they are betting on more than 100 companies. Yes or no?
Yes.
When you're buying 2 mutual funds, how many companies are you betting on?
100 something.
Correct. So you're effectively buying the market. With one mutual fund, you're buying a portfolio. With 2 mutual funds, you're buying the market. Some sort of an index you're buying, okay? So be aware when people say, I'm diversifying by investing in different mutual funds. You're not diversifying, you're diversifying. Okay? You're just going towards the average. That's clear-cut method to go to average. Okay. Even with the overlaps, those 2 funds will have humongous number of stocks in their portfolio. Okay. How many stocks in a portfolio provides enough diversification? This A study of portfolios across sizes and conditions found 80% diversification happens with 15 stocks in a portfolio. This line comes from one of the books that I recommended you to read, which is The Warren Buffett Portfolio by Robert G. Hackstock. You can read this line and the research that supports it. Excessive diversification is diversification. Charlie Munger says if you know how to analyze companies properly and you are reasonably confident about your investments, for him, even 3 companies was a good portfolio to have. Here I'm saying beyond 15, it is diversification. So 15 is the ideal number. Now it is up to you, because beyond 15, if you go, you're going in for the extra 20% of the diversification, and you're never going to get 100% of the diversification, even if you buy the whole market. Okay. So be sure, be clear how much you want and what is okay for you. Like I said, portfolio management is akin to fingerprint. You got to decide for yourself what works for you. That's all that I had. Any questions, feel free to ask.
Yeah, question. So basically, we are looking for long-term investments for more than 7 to 10 years. So as far as portfolio management is concerned, how to look for uh, some short-term goals or something.
Right.
So 5 years, 7 years. So what is your view on that?
See, for anything that has a short-term goal, don't include it in your investing. Okay.
Okay.
Have a goal-based investing approach for such short-term needs, where you go ahead and put it in some sort of a mutual fund which does not require you to take the stress of uh, taking that money out. See, for 5 years, you can take it into your equity investing portfolio. But if you have less than 3 years, then be very clear. Don't take that risk. But if you are able to find opportunities, or if you know the markets fairly, and you are like, okay, you have got stocks like uh, that are relatively large, relatively well known, and they are undervalued, and you know that they'll come back in a certain time. Like, now, this is not a recommendation. In current market scenario, as per me, I would go ahead and invest in the leading banks in India. because they are selling for real dirt cheap valuation. Yes, I know they have a challenge to garner deposits, but that's sooner or later it has to happen, or else the whole economy is going to crumble, and somehow it will come through. So I would rather buy the leading banks. When I say leading banks, I mean leading banks in terms of credit assessment. I don't mean leading banks in terms of size. Okay, the leading private banks, say HDFC or Kotak, I would go ahead and invest in them and let it be there. Uh, it's it would be a fair expectation that sooner or later they'll be back to normal. If you have such opportunities and you have clarity, you can go ahead and invest even in them. But if you don't have such clarity, let somebody else manage that headache. Put it in a mutual fund. If you are unsure about equities, put it in liquid funds and just let it be. And you'll have to uh, put up enough capital for those needs based on the potential return. So you will have to probably put up more funds, but that will let you off the hook in terms of having the headache to manage it, unless you have opportunities like that. I hope I've answered your question, Pranay.
Yeah. So basically, we'll be having two portfolios.
Yeah, think of it that way. Think of it in terms of mental accounting. Have two portfolios.
Yeah. Got it.
Never ever compromise your long-term portfolio. Your long-term portfolio is very important, because that is what is going to change the trajectory of your life. That can.
Yes.
Your short-term portfolio is never going to make you anything. Your job is never going to give you enough that you're going to become a wealthy person overnight, right?
Yes.
Similarly, short-term investments will never make you wealthy. They can make they can turn out lucky for you, make you rich for a certain time, but that's not an assured way of getting wealthy, or the process is not right, logically speaking. Anyone else? Any questions?
I have one practical question, Jeffrey.
Sure.
So let's assume I have 100 rupees, example. I bet on 20% of my money, right? Where do you keep the remaining 80%, or example, how do you make it ready for the next opportunity?
That's a very good question. Okay, Shika. So if and that's the very reason I put some in cyclical stocks. My calculation or my estimate is that by the time I have the next opportunity, which is really lucrative, these cyclical stocks would have come up. And cyclical investing is all about buying cheap, selling high. It's the whole investing is about that, but cyclical investing is more acute in terms of buy low, sell high. Okay. So that's why I tend to have that kind of a portfolio where I allocate to cyclical stocks. But if I'm unable to find any opportunities which meets my analytical criteria, I would have it in liquid stocks. I mean, I would have it as liquid cash. Uh, Probably on FD rate of return or cash rate of return. And yes, that would uh, overall reduce my performance in the long run and would cause stress because I'm not utilizing my funds. But trust me, it's not very easy to find real long-term secular opportunities, and you should always prepare and be ready with cash for such opportunities. Or you can park it in uh, relatively stable companies that are really selling cheap. Again, ones that you know of, ones we just spoke about. Those are also cyclical bets only.
Okay, and then when opportunity comes, you sell it off these large companies or whatever, maybe cyclical companies, and buy it.
Exactly. You should always be clear about your long-term aim. Okay, my aim, if I'm a sailor, if I were to give you an analogy, your short-term investment or your not short-term investment, your cyclical investments, if you are to travel from you from India to US by sea, your cyclical investments could be Cape of Good Hope and uh, probably somewhere in Europe. Okay, but uh, those those are your cyclical investments that would ultimately lead you to your final destination of US. Okay, so those are interim things. They are not. They are just stepping stones. The real goal is to find all secular investments. The real goal is never to find all cyclical investments unless you are very good with cyclicals, which is a different skill altogether. I'm not like that. But if there are people like that, then you should not worry about finding secular bets. You should just focus on cyclical bets. For that, you need to be very market savvy and all. And you can do that. That's another portfolio management style.
No.
I hope that answers your question.
Yes, yes, thanks.
Yeah, thank you. Anyone else, any questions? Hiral, you want to ask any questions? Himadri, you want to ask any questions?
Not this, but just to keep like now, just following on Srikanth's question itself, like now initially, let's say you have 100x as 100 as your long-term investment, and then you will obviously have other sources of income that keeps coming in, right? And then your 100 can keep going higher and higher and higher, right? So obviously, like plans like SIP and stuff where you can actually automatically invest new money, like how do we manage those kind of funds that is coming in? So we accumulate some total value and put it, or should we maintain something like SIP where you know that this is a company and you're betting on this, and every month you can keep adding to it, because you had 100 and then you got an additional 20 to be investing for your long term. Then would you go and just take this 20 and put into it and keep increasing your total portfolio?
Okay, that's a good question, and that depends on your personality and the valuation. Okay, so if you have a long-term bet or a long-term opportunity where you have allocated capital and it remains undervalued for good amount of time, you can keep buying as you get funds. Okay, but if you do not have opportunity, then and you are someone who has shown restraint with saving money, you can in that case accumulate that money and let it even be in cash or invest it in uh, cyclical opportunities. If you're not getting cyclical opportunities, let it be in cash or cash equivalents and let it grow. But if you are someone who's indisciplined with money, then there are instruments that help you manage your discipline part with money. You do a recurring deposit. Recurring deposit is not something that is going to yield you returns. It is going to yield you returns inferior to cash rather, or close to cash, but it is going to help you accumulate that money. It is going to help you put aside that money. Just because you are someone, if you had it in your pocket, you would squander it. Your RD will make sure that it remains till you find something worth, or till you break it. You can do that. And SIP is nothing but a learning taken from recurring deposit. Okay, you don't need to do an SIP. SIP is for people who cannot control their behavior. Okay, or who are very sort of they don't want to pay attention to the market, or uh, they don't want the hassle of finding what is undervalued, overvalued. They just want to put their money aside into investments and make sure that their buying cost is the average and they want to earn average rate of return. So SIP is a sure short way to just make sure that your behavior is managed and you earn average or near average rate of return. SIP is as good as for a person who can manage their money behavior well. SIP is like uh, uh, a compulsion or a self-created EMI sort of a structure, which penalizes you not to the extent of an EMI, but it does penalize you in some way. Why will I be liable to pay if I can control or manage my behavior? Why should I create a liability for myself? I can accumulate that and invest it when the time is right. But if I cannot control my behavior, I should accept it and do an RD and be happy with it. And if I don't want the hassle of looking at stocks and deciding whether they are undervalued, overvalued, you can do an SIP. No harm in that. It's just accepting who you are and doing it.
Right, right.
I hope. Any other questions?
Nothing. I just want to add my perspective of Hemadri's question. Yeah, as
Sure.
you rightly said, if we have an opportunity, we would buy it. And at the same time, when we buy the new one, also we will make sure that we have a right percentage. Example, if it is 20%, my overall 120 should be of 20%. So that should be example. I have 100. Example, initially I have 20% in one bet.
Lovely.
Later I got 20. Then I don't put 20 into again the same thing. Rather, I will only put 24, 4 extra.
Exactly.
That is
Exactly.
number one.
So, right. That's a very good thing.
Yeah. So the remaining 80% will be their cash. The number one. Number two is, as Shay is told, RD is one way, or you can actually do into a liquid fund. Any liquid fund is easy to put it and keep it as I mean, as whenever you really want, whenever you have an opportunity, you can withdraw. You will get it in one day, so you have to plan ahead. That's it.
Yeah, that's a very valid. Those are valid points. A liquid fund also helps. And what Shrikant said, the first point is very useful. So you should your portfolio size is not so different. People have different ways of looking at portfolio size. Some people look at portfolio size as they've decided or whatever money they started with. Some people think the way Shrikant is saying, and that's the ideal way to think. Like at that point, what is the size of your portfolio? You should go and invest as per that. There's another way that you can think about your portfolio. If you are into a job and you have some foresight of your employment, say uh, if you are creating a portfolio which is and you're just starting off in terms of portfolio management, you can think of your total portfolio as 2 to 3 years of uh, next 2 to 3 years of earnings saved as your portfolio size added to your portfolio. Okay, that will help you allocate the right amount of capital. Or else, if you're starting off, it might initially you might underinvest in good opportunities if you have good opportunities. Okay, so you can think of things that way as well. Especially when you're starting off, it does help to think of things that way. Anyone, any other questions? Okay, I think we are done with questions then. Just stop.